Welcome back. Today we're looking into using margin with high-yield ETFs. I just recently opened a margin account and am considering using it to invest in certain ETFs in the future. The margin is a 2-to-1 ratio, so if I were to put in $5,000, I could essentially access an additional $5,000 as a margin loan to invest with. As I have some experience with debt and investing by having rental properties, I feel somewhat comfortable using a bit of leverage on a quality investment. Used strategically, margin can amplify returns, especially with ETFs that are already throwing off cash on a monthly or weekly basis. We'll be covering some high-yield ETFs for margin investing, from covered call ETFs generating high double-digit yields to real estate and energy ETFs for added diversification. Let's take a look at how each ETF works, the possible risks and rewards, and how they could be incorporated into a margin portfolio. It's crucial to understand the risks involved when using margin and always be sure to do plenty of research before utilizing margin or loaning money to invest. With that said, let's jump in. First up, let's look at the Yield Max ETF series. These ETFs are all about generating the highest possible yield, many of them 30% or higher, by selling covered calls and holding synthetic positions on individual stocks. Take the Yield Max Tesla Option Income Strategy ETF, TSLY, for example. This ETF focuses solely on Tesla stock, selling covered calls to generate a massive dividend yield, often over 50%, and currently boasting 74% as per their website. Those are some juicy monthly payouts. But because of the aggressive covered call strategy, TSLY doesn't track Tesla's stock price exactly. You're sacrificing upside for that high yield. Plus, there's the risk of NAV decay, meaning the ETF's value could decrease over time due to the high dividend payouts. TSLY, for example, has already had one reverse split in its history. There are other options than just Tesla. YieldMax has high dividend-paying ETFs for other popular stocks like Nvidia, Apple, and Microsoft. They all follow a similar strategy, but remember, their performance hinges on the underlying stock's volatility and performance. You're not investing directly into the underlying stock with these. Now, if you're using margin with these ETFs, be cautious. The high dividends could be a way to pay off your margin position quickly and come out on top owning cash-flowing shares. However, a sudden drop in Tesla or Nvidia, etc. could quickly wipe out your gains, especially if you're leveraged. If you like the idea of high-income ETFs but want something a little more stable, let's take a look at JEPQ and QYLD. These ETFs also offer a solid monthly income stream without the wild swings and risk of a single stock option strategy. The JP Morgan Nasdaq Equity Premium ETF, JEPQ. As the name suggests, it focuses on the Nasdaq 100. This means a fairly solid yield, around 10 to 12%, but also a bit of volatility. And then there's the Global X Nasdaq 100 Covered Call ETF, QYLD. QYLD also focuses on the Nasdaq 100 and uses a full covered call strategy to generate a yield of around 11 to 13%. The key takeaway here is diversification. These ETFs spread their risk across multiple stocks, making them a safer alternative for margin investing than a single stock options ETF. Now let's diversify even further with high-yield ETFs in the real estate, energy, and infrastructure sectors. These sectors are known for their quality and consistent dividends. One ETF to consider is the Illyrian MLP ETF, or AMLP. AMLP invests in master limited partnerships which are primarily involved in U.S. energy infrastructure. This gives AMLP a stable cash flow and a decent yield of around 8%. Another option could be the iShares Mortgage Real Estate Investment Trust ETF, or REM. REM invests in mortgage-backed securities and real estate investment trusts, offering a juicy yield of around 10%. However, keep in mind that real estate-related stocks and funds can be sensitive to interest rate changes. Adding these types of ETFs to a margin portfolio could provide much-needed stability. So there you have it. By carefully selecting high-yield ETFs and managing margin wisely, it is possible to significantly boost passive income and come out owning cash-flowing assets. Remember, the key is to manage risk and diversify your portfolio. Be wary of putting all your eggs in one basket, especially when using margin. Always do plenty of your own research and understand the risks involved before utilizing margin. It is true margin can amplify your gains, but it can also magnify losses. If you found this video helpful, don't forget to like, subscribe, and hit the bell icon for more investment tips. Thanks for watching, and remember, stay calm, stay informed, and stay invested.